What's up? How's it going? How you doing? I hope you're having a good day. And thank you for stopping by for yet another episode of Brilliant Breakdowns hosted by me, Aaron Brill. And so once again, just as a quick reminder, as a longtime subscriber and active member to the Macro Insight community, I'm just going to be dropping by from time to time to do my best to quickly summarize, break down, simplify some of the more advanced or sophisticated jargon that you hear someone like Imran use when talking about markets. This way, I can make it a little more accessible for the everyday retail-minded investor like yourself or myself, and that way we can all learn together and better follow along with the advanced conversations like the ones you may hear in the Macro Insight membership calls. Now, in this third episode of Brilliant Breakdowns, we are going to venture a bit into the world of crypto, but please do not be discouraged if crypto isn't your cup of tea, for lack of better words, as we will still be digging into options and option strategies. Now, today's featured clip comes from the March 8th weekly call that Macro Insight subscribers get exclusive access to, where Imran points out some crypto option flows that he has spotted in the market. And so with that, let's dive into today's topic, crypto option flows, buying strangles. First things first, if you do need a primer on some basic topics like what are call and put options, then be sure to go check out the early videos from Imran on this Option Insights YouTube channel. All right, so now let's go ahead and drop in on Imran utilizing analytics from Genesis Volatility, otherwise known as GVol, where he identifies some strangles being purchased in the Bitcoin options flows.
So you can see here on the big paradigm blocks that have gone through, we saw 18th of March strangles being bought in decent size in like over 1,000 contracts. There was the 3,400 puts and the 4,200 calls. Okay, so a gamma buy there in crypto. I actually bought some gamma as well back end of last week. I just used the weeklies. I used the 11th of March and I just did a straddle. So I bought the 42,000 straddle and then I sold like an April strangle against it with the idea that the market was going to not stay at 42 and was going to move. But I didn't think April implied vols would explode, basically. So I was using that as a funding leg to own some kind of really short dated gamma. And that trade worked okay for me.
Okay, so to start our breakdown, let's go ahead and zoom in on the top part of Imran's graphic where he dissects the Bitcoin option flows and first go over what exactly we're looking at here. On the y-axis, this is the volume for the options that are being transacted, with the calls being above the zero line and puts being below the zero line. Then here on the x-axis, these are our strike prices for the options being transacted, where you have 20,000 to start all the way up to 150,000. Next, we have our different color bars representing the expiration dates for the options being transacted. So if we go ahead and look up here at the top of the screen, you can see the date and its corresponding color. Now, if you look closely, you are going to notice we have a few of these crossed out, which just means we are excluding these dates from our data set. Putting this all together, we can now go to each expiration date's corresponding color and see how many options were being transacted and at what price. Now, something you are going to notice from that explanation right there is I did not mention whether these calls and puts are being bought or sold. And unfortunately, that is something we are just unable to determine unless you're to sit there and closely follow along with the option flows as they come in. However, luckily for us, GVol does precisely that and then publishes what they're seeing in their weekly newsletter released every Sunday. So be sure to head over to the web address that you can see on the screen right now to subscribe and stay clued in on the buying and selling that GVol is seeing in both Bitcoin and Ethereum option flows. In fact, doing precisely that is what allowed Imran to point out the strangle buying on the March 18th expiry, which we can see here with a good sized navy blue bar for puts at 34,000 and calls at 42,000. Now, the other thing worth noting here is Imran saying that the buyer of these strangles is buying gamma, which you can see is also on the screen here. And what this basically means is that the person who purchased these strangles was trying to get exposed to what they expected to be income volatility in Bitcoin's price action, regardless of the direction of that volatility. Let's go ahead and get a better understanding of how exactly this works by taking a look at a payoff graph for someone buying a strangle, otherwise known as a long strangle. All right, so here we are on the strangle payoff graph. And just as a quick reminder, A strangle is when you buy or sell both an out of the money put and an out of the money call for the same expiration. And since we are talking about someone buying the strangle, this means that we are going long the put and long the call. And now if we recall the GVol analytics that we were just looking at, you'll remember that our put strike was for 34,000 and our call strike was for 42,000 on Bitcoin. And what this basically means is that the buyer of these strangles is wagering their premium spent on these options that there is volatility coming for Bitcoin that would take the price either above 42,000 or below 34,000 before March 18th of this year. And now let's quickly cut to a slightly different payoff graph to highlight some other important considerations when dealing with strangles. First, you're going to want to keep in mind that in order to make money on your strangle, you need the price action of the underlying asset to move past your break-even points. Second, you want to remember that your payoff is not all profit since you need to account for the premium spent to purchase your call and put options. These dynamics are illustrated by the graphic currently on the screen, where you see the difference between the payoff line and the profit line, in addition to your profit not kicking in until that strangle structure gets above the zero line. Lastly, it's worth noting that it is common for strangle buyers to not hold their positions into expiration. In fact, if you get a move where volatility pops, you'll likely want to take advantage of implied volatility following suit by monetizing your options. Now, just a couple quick final notes before we wrap up here. The first being, when you are buying both call and put options for your strangles, you're going to want to keep in mind the effect that implied volatility can have on the pricings of said options. If you need to learn more about this, then definitely go check out the previous episode of Brilliant Breakdowns where I went over exactly that. Additionally, at the end of today's featured clip of Imran, you likely noticed that he mentioned that he purchased Gamma by buying straddles instead of strangles, which is a similar option strategy that you can use to bet on volatility coming for an asset, regardless of the direction of said volatility. So if you'd like to learn more about straddles, then be sure to let me know in the comments below. But for now, that is going to wrap up this episode of Brilliant Breakdowns, once again with me, Aaron Brill. I hope you found this video to help deepen your understanding of how you can use volatility to your benefit. But whether or not that is the case, as always, please feel free to leave your feedback below. A big shout out and thank you to Genesis Volatility for being such an awesome friend to Options Insight. Definitely go give their offerings a closer look, but also be sure to check out the rest of the excellent content from Imran and the Options Insight team on this YouTube channel. And with that, I'll catch you here next time for episode 4 of Brilliant Breakdowns. You have a good one.